So this upcoming week is definitely going to be a big one. We're going to see how the market digests another 25 basis points. In this video, we are going to go over valuations, recession, and growth opportunities. Let's play a clip of Liz Young from SoFi.
After watching what has been a pretty solid January so far, Liz, just a sort of a relief rally, is that all?
Look, it has been a solid January, and it's been surprisingly resilient in the face of a lot of economic data that's pointing towards a slowdown. And that's not something that we can ignore, right? And I've sharpened my pencil many times already this month and looked at it and tried to say, all right, where could I be wrong? Where could I be missing something? Do I still want to be cautious? And the answer continues to be yes, I still want to be cautious. I recognize that there are some bright spots. There are still bright spots in the economic data, although they're waning. And there are some bright spots in earnings. But if you just look at the broad data so far on earnings, the number of companies beating is below all of the longer term averages. So earnings are not really all that impressive.
So the number of companies that are actually beating expectations are coming in below what usually the standard of this market is. And over the last month, the market has gone up basically in a straight line, going from 3783 on the S&P all the way up to nearly 4100. But companies have set the bar low for earnings and still are not beating. We know companies like 3M, Microsoft, Intel have longer term problems ahead. These are problems that are not going to be fixed in 1 or 2 quarters. These are problems that could take a year or two. And so while the stock price is going up, the fundamentals are kind of deteriorating here for growth rates and where the businesses are shifting. When we factor in that also small cap companies, roughly 40% of small cap companies are unprofitable. And while Jerome Powell is still set to raise rates even higher, this does not bode well for companies that are unprofitable looking for easy capital to access. When you're not making money, you need to get it somehow, and usually borrowing at low interest rates is how it's done. This is probably not going to be an option for those 40% of companies that are unprofitable. So even though slowing rates is good news, it's still going to impact corporate earnings and companies' decisions for capital. And I tend to believe that we haven't felt all the rate hikes yet. We have companies like Bed Bath & Beyond who can't pay their credit line back and is on the verge of bankruptcy. Companies like Hasbro Hospital cutting 15% of its workforce. Now, we've seen small cuts for companies that overhired due to demand being pulled forward, but this is just starting, which leads me back to valuations. When earnings reports come out, we have to run valuations to get projections of what future earnings are going to be and what current prices are today. Now, most of you know that I do think we are going to go in recession this year, but the bottom line is I really don't care if we do or if we don't. The only thing I care about is getting my valuations right. And that's why I have that watch list. And that's why we take our time and really be conservative on valuations. I personally believe that the S&P 500 should probably be trading between 34 to 3,500 without even going into a recession. As earnings are contracting, stimulus is being taken out of the economy, and now there's a competition on a risk-adjusted basis for stocks, and that is a 4.5% to 5% yield. Which leads me to my next point, and that's going to be GDP. If you believe we are heading into a recession, markets never bottom before a confirmed recession. If you're in the camp that GDP could go negative over the next few quarters, and we could be in what we consider a confirmed recession, then the bottom might not be in. But once again, I really don't care if it is or if it isn't. I've been running my valuations coming in. A lot of companies are still coming in pretty expensive here. And where's the trend going? The earnings trend is going down. Consumer spending is going down, but yet stock prices are going up. This is basically just a mean reversion that we've talked about on the channel. We went from a 4,800 S&P down to a 3,500 S&P, and now we're sitting right in the middle, right around 4,100. Between 4,000 and 4,100 is where we've kind of been trading here. We've been trading sideways. And it would not surprise me if over the next year, we trade sideways to down. And that's kind of been my argument here. I still tend to believe we're going to test or possibly even take out the lows of 3,500. But regardless, if we do or if we don't, I still run my valuations and they're still coming in fairly high. Also have to keep on the forefront here that there is still a land war going on, and there's tensions building with China as a 4-star general warns of war in 2025 with China. Now, this is not just any 4-star general. This is General Mike Minihan, who heads the Air Mobility Command. He's not just writing this letter to one individual. He wrote this letter to leadership of roughly 110,000 members. So Mike is seeing some activity, I'm pretty sure, that's leading towards tension in China. Something to keep an eye on here, ladies and gentlemen. So we have a lot of things that are making me think that this market is actually trading at a higher premium than it was when we were at 4,800 and there was tons of stimulus in the economy. Interest rates were at near zero. We take a look at where we are today. Interest rates are pushing 5%. Stimulus is coming out of the economy. Credit cards are racking up, corporate earnings are coming down, and we're roughly trading at 4,100. We factor in a land war, inflation is still elevated, and possibly tensions with China. I don't know, guys. We also have ISM manufacturing levels falling basically where pandemic levels were when the economy was completely shut down. Yield curve inversions, ISM, are usually leading indicators, while lagging indicators are going to be the job market. And yes, the job market is strong, but we're definitely starting to see some cracks there. And we obviously are going to see some interesting earnings here. I'm going to highlight McDonald's, UPS, AMD. These are companies where it's really going to impact the consumer right off the bat. Are people now not going to pay the extra dollar for a subpar cheeseburger? We obviously know Intel is dealing with some major problems. Is AMD dealing with the same problems? We have the giants of Meta and Amazon and Apple. The most anticipated earnings usually are going to be these three companies. It's really going to give us an idea of where the consumer is when we think Amazon and Apple, and is ad spending coming down? And Meta is going to be the perfect indicator for ad spending. I tend to believe that stock prices are a little high right now and earnings are coming down. Consumer is obviously slowing, as we saw with GDP numbers. As always, guys, it'll be an interesting week. Appreciate your time, and we will see you in the next one. Peace.